All right, let's jump right in. We're going to tackle one of the biggest, most mind-bending questions in all of finance. Does the market price of a stock already know everything? I mean, is the future somehow already baked in? Today, we're going to unpack this really powerful idea.
I mean, think about it for a second. You've probably seen this happen, right? A company's stock price just starts to creep up days before they announce amazing earnings. Or maybe it starts to dip right before some bad news hits the press. That is not a coincidence, and it's going to lead us right to the heart of what we're talking about today.
So how in the world can the market seem like it's predicting the future? Well, it all comes down to this really foundational belief in technical analysis, the idea that the market itself is this incredibly powerful information processing machine. The official term for this is market discounting. And the theory goes like this. At any given moment, a stock's price isn't just some random number. No, it's the sum total of every bit of known information, every hope, every fear, every analyst's prediction about that company's future. The market essentially discounts or absorbs all of that stuff into one single number, the price you see on the screen.
But, and this is a really big but, there's a limit. The market can only price in what is known, or at least what people are expecting. Rumors, earnings forecasts, economic data. What it absolutely cannot price in are the true wildcards, the genuine surprises, the things that come completely out of left field.
So here's the bottom line. That price you see is the final outcome of supply and demand, which is really just the result of millions of people making decisions. It's like a giant global election happening every second about what something is worth. And honestly, the reason why they buy or sell is way less important than the fact that they did. The action is what moves the price.
Now, this whole idea of market discounting has this, well, an academic, almost sci-fi version of it. It's a famous theory that asks us to imagine a world where the market is perfectly 100% efficient. So, what would that actually look like?
So, in this imaginary, perfect world, the second new information comes out, every single investor on the planet would see it, understand it perfectly, and react to it instantly and with pure logic. Good news, everybody buys, right now. Bad news, everybody sells. There's no delay, no confusion, and definitely no emotion.
In a world like that, a price chart wouldn't have nice, smooth curves. It would have jumps. News comes out and bam, the price literally teleports to its new, correct value. It's clean, it's logical, and yeah, it's completely robotic. Okay, that all sounds great in a textbook, but does it actually happen that way in the real world with real people? You can probably guess the answer. It's a hard no. Reality is so much messier.
I love this simple analogy. Call it the hand clap test. Imagine you ask a whole stadium full of people to clap their hands at the exact same time. What are you going to get? You get this rolling, scattered sound, right? Not one single sharp crack. It's just impossible for everyone to act in perfect unison. Well, the market is just a much, much bigger stadium.
And right here, you can see these two worlds side by side. On the left, there's that perfect blocky jump from the theory, a sharp right angle. But on the right, that's reality. Prices move in these gradual curves, slowly absorbing the news as different people react at different speeds. The market isn't a light switch. It's more like a slow, unfolding wave.
And here's exactly why it's a wave and not a switch. Because when big news hits, traders do all sorts of different things. Some dive in head first and buy immediately. Others use the good news as a chance to sell and lock in their profits. Some smart traders will wait for the initial frenzy to get overextended. And then you have the contrarians who actually bet against the news, hoping the price will fall back down. It's a chaotic mix of strategies, not one single logical move.
So, if the market isn't perfectly rational, then what is actually driving these price movements? Well, the answer lies in human psychology, especially our deep-seated instinct to follow the herd. And this brings us right back to our original question. Remember that slow upward drift in price before the big announcement? That is often caused by a small group of people who have information the public doesn't. They start buying quietly, causing the price to curve up before the rest of us even know why.
Then the news is officially out, and this is when the public, the herd, jumps in. This massive wave of public participation is what often pushes the price way up, creating that big overshoot you see on the chart. The market doesn't just adjust. A lot of the time, it overreacts because of momentum and mass psychology.
So this is so crucial to get. We aren't really trading the absolute intrinsic value of a company. We are trading the collective expectation of what everyone thinks it might be worth down the road. price is just the battleground for everyone's hopes and fears.
Okay, so let's tie this all together. We've gone from this perfect, clean theory to the messy, emotional reality of the market. So what does all this mean for how we should actually look at things?
Now, there's a common argument out there called the random walk theory, which basically says that because you can't perfectly predict the market, prices must be completely random. But the thinking here is that this just isn't true. Markets aren't random. They're driven by something far more interesting: human psychology.
And this final quote really just nails it. The reason patterns tend to repeat in the market is because they're created by people, and things like fear, greed, hope, and our tendency to follow the crowd, those things are hardwired into our DNA. They don't really change over time.
So that leaves us with one final thought to chew on. If the market is just a giant reflection of our own collective psychology, is trying to figure out the next trend a total waste of time, like predicting a coin flip? Or is it a fascinating puzzle of human behavior, just waiting to be solved? Something to think about. Thanks so much for joining me.